In this TaxSlayer Pro training video, we'll look at the forms 1099-A, acquisition or abandonment of secured property, and 1099-C, cancellation of debt. And we'll look at some examples in the TaxSlayer Pro Web version. The objectives of this training video are to distinguish between the forms 1099-A, abandonment, and 1099-C, cancellation of debt. We'll determine if there's taxable income to report. We'll talk about completing the Form 982, reduction of tax attributes due to discharge of indebtedness. We'll talk about how to enter a few examples in the TaxSlayer Pro Web software. First, some definitions and terms. A foreclosure is when a borrower in default is deprived of his or her interest or rights in a mortgaged or secured property. This is often a lengthy and expensive legal process, and the laws and procedures can vary from state to state. The lender regains possession and control over the secured property, or, again, a repossession. For tax purposes, a foreclosure is treated as a sale of the property, so the borrower will have a realized gain or loss. Abandonment occurs when a borrower voluntarily and permanently gives up possession and use of the property with the intention of ending his or her ownership. There's no direct conveyance to the lender. An abandonment is also considered to be a sale or exchange of property for income tax purposes. An abandonment is most often reported on Form 1099-A. A voluntary conveyance, voluntary surrender of property to a lender in exchange for full or partial discharge of the debt it secures, is considered voluntary conveyance. It's not considered to be an abandonment. It's also considered to be a sale or exchange of property for income tax purposes. And it's an alternative to the foreclosure process. As tax preparers, our main function is to help our clients understand what's going on the tax return. What do the documents mean that they've received in the mail? On the other side of the desk, the client's perspective on foreclosures. We've probably heard phrases like this: the bank just took my house. I don't understand the whole paperwork process. I just don't want to deal with it. They just kicked us out. And again, it's our job as preparers to help the client understand what's going on the tax return and how to report a 1099-A or a 1099-C that the client may have received in the mail. Form 1099-A. Box 1 indicates the date of sale. In other words, the date of the lender's acquisition or the knowledge of abandonment. That's why we have sale in quotations. Box 2 indicates the amount owed or the balance of principal outstanding. Box 4 indicates the fair market value on the date of the quote sale. This is the gross foreclosure bid price. Box 5 indicates if this was a recourse loan. If this box is checked, the borrower was personally liable for repayment of the debt. Box 6 gives a description of the property. Now, we talked about recourse debt on that form just a moment ago. So what's the difference between recourse and non-recourse debt? Well, recourse debt, the borrower is personally liable for repayment of the outstanding debt after the foreclosure sale proceeds have been applied. The lender can pursue a deficiency judgment, and recourse debt cancellation may result in taxable income to the borrower. Non-recourse debt, the borrower has no personal liability after a foreclosure, and no taxable income results from the cancellation of debt. Now, going back to our Form 1099-A, the difference between recourse and non-recourse debt. Recourse debt, box 5, is checked. The sale price indicated on this form is the lesser of box 2 or box 4. Again, this is if the recourse debt box is checked. The the sale price is the lesser of the balance of the principal outstanding or the fair market value of the property. In non-recourse debt, box 5 is blank, so the sale price is box 2, the balance of principal outstanding. There's some additional questions that we need to ask the taxpayer if he or she receives one of these documents. Was the property for personal use? Was it business? Was it rental property? What was the purchase date? Was the property a principal residence? Was the property a vacation home? What's the cost basis of the property? Was there any depreciation ever taken on the property? Were there any improvements made? And were the property taxes paid, and are they current? Now let's take a look at our first example. Our taxpayer, Stephen Cabela, receives a 1099-A on his principal residence. Now the sale price is $100,000, the fair market value of the property, because this is a recourse debt. He's personally liable for repayment of the debt. So, Mr. Cabela is on the hook for any additional amounts owed after the foreclosure sale. The $120,000 in box 2 minus the $100,000 in box 4 leaves a $20,000 balance. This may generate a 1099-C in the future. Now we've entered Mr. Cabela's personal information into the ProWeb software, and we're here at the Income menu. And from the client's income screen, we'll select Begin Capital Gain and Losses, Schedule D. We'll select Capital Gains and Loss Items, and we'll enter the information on the Capital Gains transaction screen. For our example, the date the house was originally purchased was March 1st, 2015, and the quote sale date from the 1099-A is listed as 07/18/2018. The original cost basis of the residence was $165,000. The sale price of $100,000 is entered from the 1099-A. And we also want to indicate that the client did not receive a Form 1099-B for this transaction. Next, we're going to enter a positive amount in the adjustment screen to offset the $65,000 loss from the, quote, sale of the personal residence. So here we'll enter a positive $65,000. Losses are disallowed as tax deductions on personal use property. Next, we need to select an adjustment code that will appear in column F of the Form 8949. And we'll choose L, non-deductible loss other than a wash sale. On this screen, we'll click Continue. And on the next screen, we'll click Continue again. Now we can look at Part 2 of the Form 8949 after we've entered the 1099-A information. And recall the Form 8949 carries to the Schedule D. We see that box F is checked, long-term transactions not reported on a Form 1099-B, and the $65,000, quote, loss is disallowed. Well, what if the original cost of the personal residence had been $75,000 instead of $165,000? At first appearance, looks like there's a gain of $25,000 on the, quote, sale of the residence. The $100,000, the sale price, minus $75,000, the cost basis, equals $25,000. What we need to do is adjust the $25,000 gain by entering a negative $25,000 in the adjustments screen. And for the adjustment code, we would select H, exclude some or all of the gain from the sale of your main home. The Form 8949, after indicating the code and entering the adjustment amount, would look like this. And because the taxpayer lived in the house for 2 out of the last 5 years, he gets to exclude the gain under Section 121. Now, some other issues that might arise. Delinquent property taxes that are paid before foreclosure or with any foreclosure sale funds could possibly be deducted on Schedule A. The $20,000 balance from the recourse loan that's indicated by the Form 1099-A will be reported on a 1099-C in the future. And the taxpayer may have a right of redemption. This varies by state. After foreclosure, the taxpayer could pay $100,000 cash for the house and get his house back. Some other issues: an incorrect Form 1099-A or 1099-C may be issued, and the lending institution should move to correct this. An immediate appraisal can often increase the fair market value, showing a lower, quote, gain. All right, let's look at another example. Example 2. Our taxpayer, Michael Taylor, receives a 1099-A on a piece of rental property, and his condominium unit was purchased March 1st, 2013, and it was used as a rental only. The original cost was $120,000, and depreciation has been taken over the years of $23,271. This is a non-recourse loan. Box 5 is blank, so the sale price is $108,000 from Box 2. Now let's look at how we'd enter this 1099-A into the TaxSlayer ProWeb software. We're at the Income menu, and we're going to begin at Other Income. Takes us to Less Common Income. We're going to access the Sale of Business Property, the Form 4797, since this was a rental property. We're at the Form 4797, Sale of Business Properties, and I'm going to add a 4797 transaction, and I've entered the information from the client's records, the date acquired, 3/1/2013. 7/18/2018 is the date, quote, sold from Box 1 of the 1099-A. The, quote, sales price was $108,000 from Box 2 of the 1099-A. We were told that depreciation of $23,271 was taken over the years, and the cost basis of the rental condo from the client's records was $120,000. Now we're selecting on the transaction type, Part 3, Section 1250, because this is depreciable real property. It's residential rental building. Once I've entered all that information, on the next screen, I'll click Continue. I have no other data on the 4797 to enter, so I'll click Continue once again. On this screen, I'll hit Continue once again on the 4797 Sale of Business Properties. And now I can take a look at my 4797. I can print or view it and look at page 2. I see I've recaptured my depreciation amount, and I have a recognized gain of $11,271. That gain will flow to page 1 of the 4797. And ultimately, the gain flows to Schedule D on the client's tax return. From there to Schedule 1 of the 1040, and then to the Form 1040 itself, line 6. Next, let's fall back a moment and look at the relationship between a 1099-A and a 1099-C. First, the 1099-A. Generally, a homeowner will receive the 1099-A from a lender after a piece of property has been foreclosed on. The Form 1099-A is regarded as an informational form, and typically a 1099-C, the cancellation, will soon follow. For income tax purposes, a foreclosure we've seen is treated as a sale, and the borrower must then calculate capital gains or losses. Because the property wasn't sold, there is no selling price. Instead, the borrower or taxpayer uses the information from the 1099-A as the date of sale, box 1, and the selling price of the property. The borrower may use the fair market value, box 4, or the outstanding balance, box 2. How to report the foreclosure on the tax return depends on the character of the property. Was it a primary residence? The state the property is located, and the purchase price. Next, the 1099-C. If the taxpayer receives a 1099-C as a result of a foreclosed property, then he or she may have also received a 1099-A. Typically, the 1099-A is issued first. The 1099-C, generally has the same information as the 1099-A, but also includes the additional information that the debt has been canceled. Canceled debt may require the borrower to report the canceled amount as taxable income. The IRS may add the canceled amount to gross income and require income tax to be paid on that amount. 1099-A versus the 1099-C, the taxpayer might receive 1099-C instead of the Form 1099-A if the lender both foreclosed on the property and canceled any remaining mortgage balance owed as well. In this case, the IRS takes the position that income was received from the foreclosure because money was received from the lender to purchase the home and the money wasn't repaid. Now let's move into cancellation of debt. What is cancellation of debt? It's a release of a debt burden by a creditor. Now this can involve a secured debt, and secured debt uses a house, a car, or other property as collateral. This cancellation is often a two-step process: foreclosure, repossession of property. And any debt not satisfied through repossession of the property may be subject to a deficiency judgment. In the case of recourse debt, the collection will often be pursued, and the debt may eventually be forgiven or canceled. In the case of unsecured debt, an example is a credit card, then no property is used as collateral. As a general rule, cancellation of debt results in taxable income to the taxpayer. It's reported on line 21 of Schedule 1, Form 1040. May also be reported on Schedule C, E, or F instead. And cancellation is a separate event from foreclosure or repossession. There are exceptions where no Form 982 is involved: a gift, a deductible debt, we'd have to attach a supporting statement, purchase price reduction, and non-recourse debt, and some student loan forgiveness programs. Now there are some exclusions to reporting cancellation of debt income found on Form 982, Title 11 bankruptcy, insolvency, qualified principal residence indebtedness. Now, the exclusion applies only to debt that was discharged after 2006 and in most cases before January 1st, 2018. Reduction of tax attributes. This is Form 982, Part 2. This reduction of tax attributes serves as sort of a balancing act for reporting any exclusion of income. Bankruptcy Involves Title 11 of the U.S. Code, Chapter 7, Liquidation, Chapter 13, there's a repayment plan, 3 to 5 years. Insolvency can exclude cancellation of debt from income to the extent of insolvency that's reported on the Form 982. And this is a snapshot. It's taken the day before the debt cancellation. Liabilities have to be greater than the fair market value of all assets owned. The extent of insolvency equals the exact amount of the excess liability. We use the Publication 4681 worksheet or a similar worksheet. Your client needs to keep detailed records. And again, we refer to Publication 4681, Canceled Debts, Foreclosures, Repossessions, and Abandonments for Individuals. And the insolvency worksheet is found in the publication. Now let's take a quick peek at qualified principal residence indebtedness. This goes for the main home only, and it may exclude acquisition debt only. And that acquisition debt is used to buy, build, or substantially improve the main residence. Non-acquisition debt, home equity debt, is incurred for non-home purposes. Points and other closing costs that are rolled into the principal on refinancing of the acquisition debt are considered non-acquisition debt. And the non-acquisition debt, those bullet points, that's the first debt to be canceled. This produces taxable income. A 1099-C, in this case, would be issued on this non-acquisition debt. Now, if your debt was discharged after 2017, or your client's debt discharged after 2017, the client can't exclude it from income as qualified principal residence indebtedness unless the discharge is subject to an arrangement that was entered into and has to be evidenced in writing before January 1st, 2018. Part or all of the debt may still qualify for one of the other exclusions from 982. Now let's take a look at the components of the Form 1099-C. Box 1 lists the date of the debt cancellation. Box 2 lists the amount of the debt that's been canceled. Box 3 lists any interest, if there was any, included in Box 2. Box 4 gives a description of the debt. Box 5 indicates if the debt was a recourse debt. Now remember, if the box is checked, this means were you personally liable for the debt. Box 6 lists an event code. The event code, why did the creditor file the form? And the codes are defined in the 1099-C instructions. Box 7 lists the fair market value of any property. This is used only in what we call combo 1099-C reporting. So what is combo reporting? Combo reporting, or streamlined reporting, is available when the foreclosure or repossession takes place in the same calendar year as the cancellation or the forgiveness of debt. Some indicators are real estate description in Box 4 or fair market value listed in Box 7. Now, as far as the 1099-C correlation to the Form 1099-A that we talked about at the very beginning, the 1099-C, Box 2, listing the amount of the debt discharged, plus Box 7, the fair market value of the property, equals the balance of the principal outstanding. And this amount correlates to Box 2 of the 1099-A. Now let's take a look at our third example. A 1099-C resulting from the cancellation of debt on a principal residence. And we see that Code G has been used in Box 6. Code G is used to identify cancellation of debt as a result of a decision or a defined policy of the creditor, in this case First National Bank, to discontinue collection activity and cancel the debt. And so that we can relate this example to the tax program, we're going to assume that the discharge of Mr. Buckner's debt is subject to an arrangement that was entered into and evidenced in writing before January the 1st, 2018. Remember, qualified principal residence indebtedness is any mortgage that you took out to buy, build, or substantially improve your main home. It also must be secured by the main home. Now let's open up the ProWeb program and see how we enter this 1099-C. We're at the Income menu, and we'll start off in the Other Income section. This screen gives us access to less common income, and we'll begin at the Cancellation of Debt Form 1099-C and Form 982. This will take us to the Cancellation of Debt screen. We'll begin with the Form 1099-C, and we'll enter the information from the 1099-C. We get the amount of debt canceled from Box 2 of the 1099-C, and we'll click Continue. On the next screen, the Form 1099-C Cancellation of Debt. We can click Continue on this screen. And because the 1099-C was generated from the quote sale of a personal residence, we're going to access Form 982, Exclusions. This takes us to the Reduction of Tax Attributes screen, and we're going to indicate that the amount to be excluded from income is due to the discharge of qualified principal residence indebtedness. We're going to enter the amount from Box 2 of the 1099-C. We'll click Continue to move on. We've now reported the 1099-C and subtracted the discharge from indebtedness from the taxpayer's income. We can click Continue. We're at the Cancellation of Debt screen. Click Continue once again. We're back at the Less Common Income screen. Click Continue. And now we can look at the Form 982. We can view or print this form. And again, in this example, all of the mortgage debt was qualified principal residence indebtedness. And so on line 2, we have a total amount of discharge indebtedness excluded from gross income. Now for our fourth and final example, we're going to look at a 1099-C issued by the Visa Credit Card Company to Clark Howard. This is an example of insolvency, how to report insolvency in the ProWeb version. Now, a bankruptcy event code is not listed or present, so we go to insolvency. Now, entering this 1099-C into the tax program, we've entered Mr. Howard's personal information. We're at the Income menu. We're going to select or begin with Other Income. And we'll select Cancellation of Debt Form 1099-C and Form 982. We're at the Cancellation of Debts window. We'll select or begin with Cancellation of Debt Form 1099-C. And we enter the information from the 1099-C. And when everything is correct, we'll select Continue. We're back at the 1099-C Cancellation of Debt screen. We see that we've entered the creditor's information, the debt canceled, $53,500. We'll select Continue. Now to enter the insolvency worksheet information for this client, we'll select Exclusions, Form 982, from the Cancellation of Debts menu. We'll check the Discharge of Indebtedness due to extent insolvent box. And we're going to need to calculate the amount of indebtedness that's to be excluded from gross income. How do we do this? Well, to calculate the amount of indebtedness to be excluded from gross income, we're going to need to access the insolvency worksheet from the publication 4681. Here's what the insolvency worksheet looks like. And here's our completed insolvency worksheet for our client, Mr. Howard. We've entered his liabilities and assets in order to determine the amount of insolvency we can report on the tax return. In this case, $41,000. So we enter the amount of insolvency from the worksheet, and in this scenario, the client can exclude some of the debt, but not all. And again, looking at our Form 982 for the taxpayer, we see on line 2 that he's only able to exclude $41,000 from gross income. The taxpayer will have to report $12,500 of income on Schedule 1, line 21 of the Form 1040. How did we get this figure? $53,500 from the 1099-C minus the $41,000 from the 982 equals $12,500. The $12,500 shows up on line 6 of the 1040. So in summary, foreclosure and cancellation of debt are two separate reportable events for a taxpayer. They're reported on a 1099-A and a 1099-C. In some cases, streamlined reporting, the taxpayer will receive a 1099-C only. In some cases, the 1099-A will precede the 1099-C. Information gathering is essential for correct reporting and minimizing the tax liability for our clients. And remember, foreclosure is reported as a, quote, sale. Canceled debt is ordinary income unless an exception or exclusion applies, and we report these on Form 982. And thank you for watching this TaxSlayer Pro training video on 1099-A and 1099-C reporting.